July 6, 2018. President of U.S. announces the first wave of tariffs on Chinese goods, $34 billion worth. The trade war officially begins. America is finally standing up to China, bringing manufacturing back home. Both political parties united. The entire establishment says we're going to fight back. But on that exact same day, something else happened that nobody was paying attention to. 1 month earlier, on June 1, 2018, MSCI, the company that controls where trillions of institutional dollars flow, officially started including Chinese A-shares in its emerging markets index. And when MSCI includes a market in its indices, pension funds, sovereign wealth funds, university endowments, insurance companies, every institution that tracks those indices must put money into that market, not because they choose to, because they have to follow the index. Between 2018 and 2020, during the absolute peak of Trump's trade war, BlackRock, JP Morgan, and Goldman Sachs quietly moved billions into Chinese markets. BlackRock alone invested at least $1.9 billion in companies blacklisted by the U.S. government, companies building fighter jets for the People's Liberation Army, companies producing nuclear weapons capable of striking the continental United States, companies involved in the Uyghur genocide. While Washington performed resistance, Wall Street executed integration. This wasn't a mistake. This wasn't bad timing. This was the most predictable move in modern financial history, because there's a pattern that's repeated itself for over 300 years, a pattern so reliable, so mathematically precise, that once you see it, everything happening to American economic power right now becomes crystal clear, and we're in stage 3 of 4. If this information matters to you, hit that subscribe button right now, turn on notifications, share this with someone who needs to understand what's really happening, because by the end of this video, you'll see the mechanism that has destroyed every reserve currency in recorded history. And you'll understand exactly where we are in that cycle. The 4-stage pattern that never fails. The global financial system isn't random. It isn't chaos. It runs on a 4-stage mechanism that's destroyed every single reserve currency in history. Rome, Amsterdam, London, and now, Washington. Stage 1, financial elites create a monopoly on money printing through a central bank. Stage 2, they use this monopoly to finance government expansion through debt. Everything looks great. Economy booming, empire expanding. Everyone thinks they've figured it out this time. Stage 3, the system overextends. Currency starts losing value. Government loses control. Cracks appear everywhere. Stage 4, and this is the crucial part, the same people who built the system move their money to the next rising power before the collapse is obvious to everyone else. The population gets left holding worthless paper while the architects are already positioned in the next empire. We've seen this pattern in Britain, we've seen it in Germany, we've seen it in America after 1971, and it's happening again right now as Wall Street pours billions into China while Washington puts on a show about getting tough with Beijing. Let me prove this to you with 3 undeniable historical examples. Then I'll show you the exact same mechanism executing in real time today. Britain, the Bank of England, and the transfer to America. Let's start in 1694. Britain is at war with France, running out of money. A financier named William Paterson comes up with a brilliant solution. Create the Bank of England. The deal is simple on the surface, but revolutionary in its implications. The bank loans the government £1.2 million at 8% interest. But here's the genius. The government creates debt. The bank turns that debt into money that circulates through the economy, and the wealthy subscribers to the bank, they collect interest on the nation's entire money supply. Stage 1 complete. A private institution now has a monopoly on creating the currency. Within 4 years, Britain's national debt explodes from £1.2 million to £16 million. Why? Because once you establish the mechanism where debt becomes money, there's no limit to how much debt the government can create. By 1815, after financing the Napoleonic Wars through continuous money printing backed by government debt, the national debt hits £885 million. The lenders didn't just profit, they owned the British government. Every tax collected went first to service the debt. This is stage 2, using the money printing monopoly to finance government expansion. And for a century, it looks unstoppable. Britain builds the world's largest navy, colonizes half the planet. The pound sterling becomes the global reserve currency. International trade runs on British pounds. Foreign governments hold pounds as reserves. British banks finance global commerce. Everything looks permanent. Britain is on top of the world. But here's what most people don't understand. By the mid-1800s, the cracks start showing. British industrial production peaks and begins declining relative to Germany and America. The cost of maintaining a global empire grows faster than Britain's economy can support. The debt starts climbing again, but this time there's no new frontier to exploit. This is stage 3, system overextension. And here's where it gets interesting. The same financial institutions that built the British system start moving their money to America. British capital pours into American railroads, American steel, American industry. The Rothschild family, architects of European finance, begin financing American expansion. By the time Britain officially abandons the gold standard in 1931, by the time the pound collapses as the reserve currency, the financial elite have already rebuilt the exact same system in New York. They moved the money before the collapse was obvious. Stage 4 executed perfectly. The British population held pounds that lost 90% of their value over the following decades. But the architects of the system, they were already positioned in American dollars, American industry, American power. Germany. Weimar hyperinflation and Wall Street's entry. Second example. Germany after World War I. The Treaty of Versailles hits Germany with 132 billion gold marks in reparations. Massive debt owed to the Allied powers. Germany faces an impossible choice. Raise taxes dramatically to pay the debt, which would crush an already devastated economy and trigger immediate political collapse. Or print money to meet obligations while keeping the domestic economy functioning. They choose the printing press. The Reichsbank, Germany's central bank, starts monetizing government debt, paying striking workers, funding social programs, keeping the political coalition together. When France and Belgium occupy the Ruhr industrial region in January 1923 to seize coal and force payment, Germany's response reveals everything. Pay Ruhr workers to strike, pay them with printed money, keep the resistance going no matter what it does to the currency. The money supply goes absolutely insane. May 1923, 8.6 billion marks in circulation. June, 17 billion. August, 669 billion. November 1923, 400 quintillion marks. By November 1923, $1 buys 4.2 trillion German marks. A wheelbarrow full of cash won't buy a newspaper. Workers get paid by the hour because their wages are worthless by the end of their shift. People burn money for heat because it's cheaper than buying firewood. Prices rise during working hours. The middle class gets completely wiped out. Generational savings evaporate overnight. And here's the part they don't teach you in school. This wasn't accidental policy failure. Rudolf Havenstein, the Reichsbank president, deliberately bought foreign currency with marks at any price regardless of what it did to inflation. The government claimed this was necessary to pay reparations. British and French financial advisors said it was deliberate currency destruction. Later records confirmed it. The hyperinflation served multiple purposes. It eliminated domestic war debts. It destroyed the politically inconvenient middle class who supported the old imperial order. It created conditions for radical political change. When the crisis peaked and Germany introduced the Rentenmark in November 1923 to stop the bleeding, the solution required American loans. The Dawes Plan of 1924 brought Wall Street into Germany to restructure everything. U.S. money flooded in through the late 1920s. American banks and corporations gained massive exposure to German industry. J.P. Morgan, Goldman Sachs, all the major players. Then when that system collapsed in the early 1930s, creating the conditions that brought the Nazis to power, those same American financial institutions were already positioned for the next phase. They had extracted what they needed and moved on. Same pattern, different century. Central bank monetizes government debt. System expands through inflation. Currency collapses. Foreign capital restructures during the crisis. Then exits before the political disaster. The German middle class was destroyed. But Wall Street? Wall Street was already building the next empire. America, Bretton Woods collapse, and the petrodollar. Third example. The one that created today's system and is now unraveling in real time. July 1944. Bretton Woods, New Hampshire. Representatives from 44 nations create a new monetary order while World War II is still raging. The US dollar gets pegged to gold at $35 per ounce. Every other currency pegs to the dollar. Foreign central banks can redeem their dollars for physical gold at that fixed rate. The dollar becomes the global reserve currency backed by the largest gold reserves in history stored at Fort Knox. This is stage 1. America establishes monopoly on global money through gold backing. For 2 decades it works beautifully. Europe and Japan rebuild using American dollars. The dollar circulates globally as the medium of international trade. American economic dominance is total. Foreign nations hold dollars as reserves. American banks finance global development. The system appears permanent and unshakable. But then America starts using its ability to print the reserve currency to finance the Vietnam War, the Great Society programs, the Cold War military buildup, all without raising taxes proportionally. This is stage 2. Using the money monopoly to finance massive government expansion, the Federal Reserve expands the money supply. Interest rates stay artificially low. The economy keeps growing on paper. Dollars flood into foreign central banks as America runs bigger and bigger trade deficits. By 1971, there are way more dollars circulating internationally than the United States has gold to back them. The math doesn't work anymore. This is the beginning of stage 3. France sees what's happening first. Under President Charles de Gaulle, they start demanding physical gold for their dollars, testing whether America will honor the Bretton Woods Agreement. In August 1971, French President Georges Pompidou sends a battleship to New York Harbor to collect French gold. Switzerland exits the system on August 9th. On August 11th, Britain formally requests $3 billion worth of gold moved from Fort Knox to New York for redemption. Paul Volcker, then Under Secretary of the Treasury, said later that when Britain, the country that helped found the system and fought to defend their own currency's reserve status for centuries, started taking gold for dollars, everyone in the Treasury Department knew it was over. The game was up. By August 15th, only 10,000 metric tons of gold remained in U.S. reserves, not nearly enough to honor the outstanding dollar obligations to foreign central banks. August 15th, 1971, Sunday evening, President Nixon goes on television and announces the United States is temporarily suspending dollar convertibility to gold. The gold window closes. America defaults on its Bretton Woods obligations. That temporary measure is still in effect today, 54 years later. The Bretton Woods system collapsed completely. By March 1973, the world moved to floating exchange rates. The dollar became pure fiat currency backed by nothing except government promise and, critically, U.S. military force in global oil markets. Since that day, the dollar has lost over 98% of its value against gold. In 1971, gold was $35 per ounce. Today, it trades over $3,000 per ounce. Same pattern as always. System overextension, loss of monetary discipline, currency debasement. But stage 4 is what matters most. The financial institutions that built the Bretton Woods system didn't collapse with it. They adapted. They created the petrodollar system in 1974, forcing oil to be priced in dollars globally, creating artificial demand that extended dollar dominance for another 50 years. But now even that system is breaking down, and those same institutions are executing stage 4 again. Moving capital to the next rising power before the final collapse becomes obvious. China, the trade war theater and the real financial integration. Now let's apply this pattern to what's happening right now. Let's look at the hard evidence. The data that proves Wall Street executed the exact same stage 4 transfer during Trump's trade war. July 6, 2018. Trump imposes the first tariffs on Chinese goods, $34 billion worth. The trade war officially begins. Media coverage is massive. Political establishment united. America is finally going to stand up to China, rebalance trade, bring manufacturing back. Both parties support it. The narrative is total resistance. But July 6, 2018 is significant for another reason that received almost zero media attention. It's exactly 1 month after June 1, 2018. The day MSCI, Morgan Stanley Capital International, the company that controls global investment indices, officially started including Chinese A-shares in its emerging markets index. Think carefully about what this means. When MSCI includes a market in its indices, institutional investors who track those indices must put money into that market, not because they choose to, because they contractually follow the index. Pension funds, sovereign wealth funds, university endowments, insurance companies, trillions of dollars that mechanically follow wherever MSCI directs them. On June 1, 2018, the first inclusion of A shares in the MSCI Emerging Markets Index officially took effect, comprising 234 stocks with an initial inclusion factor of 2, 5%, and a weight of 0, 39% of the index. MSCI stated that as of the June 2018 inclusion, A shares comprised 0, 39% of the emerging markets index's weight, with this increasing to 0, 78% by August 2018. That sounds small, less than 1%, but here's what the financial press didn't emphasize. The initial inclusion was expected to attract over $20 billion in inflows to the Chinese market, and in the long term, full inclusion could drive over $800 billion into Chinese A shares, and the weighting was always designed to increase systematically. By November 2019, MSCI had increased the A shares inclusion factor to 20%, meaning A shares had a 1% weighting in the MSCI China Index, and a 1% weighting in the MSCI Emerging Markets Index. But remember, China already comprised nearly 30% of the MSCI Emerging Markets Index before A shares were even included. So between June 2018 and November 2020, China's total weight in the Emerging Markets Index, the index that controls where institutional capital flows, went from roughly 30% to over 43% during the exact period of Trump's trade war. This wasn't coincidence. This was systematic capital allocation happening while Washington performed political theater. Between 2018 and 2020, during the peak of the trade war, U.S. portfolio investment in China hit record levels. Now let's talk about specific firms and specific investments. In April 2024, the bipartisan House Select Committee on the Strategic Competition between the U.S. and the Chinese Communist Party released a report detailing how asset managers and index providers facilitated investment of more than $5 billion to 63 companies in the People's Republic of China that have been blacklisted or red flagged by the U.S. government. These aren't just any companies. According to the committee report, these companies develop advanced fighter jets and nuclear weapons for the People's Liberation Army and create technology used to perpetrate the ongoing genocide against the Uyghur people. The committee found that nearly 59% of this $5 billion, approximately $8 billion, was invested through asset managers Vanguard and BlackRock, which each accounted for about $9 billion of the total. Let me repeat that. BlackRock alone invested at least $1.9 billion in Chinese companies that the United States government has officially blacklisted. According to the Coalition for a Prosperous America report from May 2024, BlackRock invested in about 30 subsidiaries of Chinese defense contractors that have been banned since 2022 by the Treasury Department. The report states that BlackRock has nearly $200 million invested in companies that help produce nuclear warheads capable of striking the continental United States. But it gets worse. BlackRock funds own 4 companies on the Uyghur Forced Labor Prevention Act entity list, holding about $50 million of stock in companies under U.S. sanctions for participating in the systematic campaign of oppression against the Uyghurs and other minority groups. These aren't passive, accidental holdings. BlackRock offers the iShares MSCI China ETF, which had assets under management of about $6 billion, of which approximately 0.01% or $230 million was in Chinese firms flagged by U.S. government agencies. BlackRock's iShares Core MSCI Emerging Markets ETF had about $79 billion in assets under management, of which 78% or $556 million was in blacklisted or red flagged Chinese firms. Now BlackRock's response to congressional investigations is revealing. BlackRock told Fox Business in a statement that the company complies with applicable U.S. laws, that this matter reflects the entire asset management industry, and that Congress and the administration must work together to create clear rules of the road for U.S. investors. Notice what they're saying. They're not denying the investments. They're saying everyone is doing it, and that it's technically legal because these companies aren't on the specific Treasury ban list for capital markets, only on Defense Department and State Department entity lists. This is the key. The financial integration was designed to be technically legal while completely undermining stated national security policy. But BlackRock isn't alone. In September 2021, BlackRock's Chinese subsidiary set up its first mutual fund in China after raising 68 billion yuan, approximately $1.03 billion, from 111,000 Chinese investors in just a few days. BlackRock became the first foreign-owned company allowed by Beijing to operate a wholly owned business in China's burgeoning mutual fund industry. Think about the timing, September 2021. The trade war rhetoric is still ongoing. U.S.-China tensions are at historic highs, and BlackRock is launching mutual funds for Chinese citizens while simultaneously channeling American retirement savings into Chinese military contractors. J.P. Morgan followed the same playbook. According to Fortune magazine, J.P. Morgan Chase is the top foreign asset manager in China, followed by UBS Group, Invesco, BlackRock, Schroders, and Fidelity. These firms expanded their Chinese operations throughout 2018, 2019, and 2020 during the trade war. J.P. Morgan got approval for a majority-owned securities business in China. Goldman Sachs increased its stake in its Chinese joint venture. These weren't passive investments tracking an index. These were active business decisions to expand operations inside China while Washington claimed to be decoupling. According to BlackRock's own announcements, the firm's onshore China investment quotas under the Qualified Foreign Institutional Investor and Renminbi Qualified Foreign Institutional Investor schemes amounted to approximately $26 billion as of March 2019. That's just BlackRock's direct onshore quotas. not counting all the index funds, ETFs, and offshore structures. $9.26 billion of access to Chinese capital markets in March 2019, peak trade war period. The pattern is undeniable. While Trump imposed tariffs and threatened tougher action, while both political parties talked about standing up to China, while the media covered trade war developments as if they represented real decoupling, Wall Street was systematically integrating American capital into Chinese markets at an unprecedented scale. The trade war was theater. It was designed to fail, or more precisely, it was designed to appear as if America was resisting, while the actual financial integration accelerated behind the scenes. In the next part, I'll show you the current numbers that prove we're deep in stage 3 of the pattern, the U.S. national debt, the debt to GDP ratio, the Federal Reserve's balance sheet, the mathematical impossibility of the current trajectory, and most importantly, I'll show you the evidence that stage 4, the capital transfer to China, is not just continuing but accelerating, even under Biden and now under Trump's second administration, because the pattern doesn't care about political parties, it doesn't care about rhetoric, it only cares about mathematics, and the mathematics says the dollar's reserve currency status is ending. Wall Street knows it, Beijing knows it, the only question is whether you'll see it before it's too late to position accordingly. Make sure you're subscribed, turn on notifications, because what comes next will determine your financial future for the next 2 decades. The wealth transfer is happening right now. The only question is which side of it you'll be on. Where we are in the pattern right now. Let me show you exactly where we are in the 4-stage pattern. The numbers don't lie. They reveal a system in advanced stage 3 approaching stage 4 completion. As of December 2025, the United States national debt stands at $38 trillion with a debt to GDP ratio of 121%. That's the highest peacetime ratio in American history. For comparison, debt was only 25% of GDP when Paul Volcker crushed inflation in the early 1980s. The Congressional Budget Office projects debt will reach 119% of GDP by fiscal year 2035 and climb to 156% by 2055. But those projections assume no major crises, no recessions, no wars, no pandemics. Under alternative scenarios that account for making temporary tax cuts permanent and other likely policy extensions, debt could reach 134% of GDP by 2035. The Federal Reserve's balance sheet tells the same story. As of December 31, 2025, the Fed's assets stand at $6.6 trillion. To put that in perspective, in August 2007, before the financial crisis, the Fed's balance sheet was only $870 billion, equal to approximately 6% of GDP. The Fed reduced its balance sheet from $8.9 trillion in 2022 to $6.5 trillion in 2025 through quantitative tightening. But it's still nearly 8 times larger than before 2008. And here's what matters. The Fed can't shrink it much further without causing a liquidity crisis in financial markets. The system now requires a permanently enlarged central bank balance sheet to function. That's stage 3 behavior, permanent monetary expansion to support an overextended system. And then there are interest payments. In fiscal year 2026, net interest payments are projected to reach $1 trillion, representing 3.2% of GDP. By 2035, interest costs will climb to $1.8 trillion annually, representing 4.1% of GDP. Over the 10-year budget window from 2026 to 2035, interest payments will grow 76%, faster than any other major spending category. Social Security will grow 58%, Medicare 75%. But interest payments, the purely financial cost of past borrowing, will grow 76%. That's the debt trap closing. Former Federal Reserve Chair Janet Yellen warned that the preconditions for fiscal dominance are clearly strengthening, noting debt is on a steep upward trajectory toward 150% of GDP over the next 3 decades. Fiscal dominance. That's the technical term for what happens in late stage 3. When government debt becomes so massive that it dominates monetary policy, when the central bank can no longer set interest rates based on economic conditions, but must set rates based on what the government can afford to pay. Eric Leeper, a professor at the University of Virginia and former Federal Reserve economist, explained that when Volcker raised rates in the early 1980s, debt was only about 25% of GDP, so it took a long time for interest payments to affect the budget. But by 2026, the sheer magnitude of the debt means the impact of rate hikes is instantaneous and counterproductive. Think about what that means. Raising interest rates to fight inflation now pumps money into the economy through higher interest payments to bondholders. The normal tools of monetary policy have been inverted. The system is trapped. This is exactly what happened to Britain in the 1920s. exactly what happened to Weimar Germany, exactly what happened to America after Vietnam. The debt becomes so large that standard policy tools stop working. At that point, stage 4 begins. The architects of the system start moving capital to the next power center. The capital transfer to China is accelerating. And that's exactly what's happening, not just during Trump's first term, not just during the 2018 to 2020 trade war. The transfer is continuing and accelerating right now. Let me show you the current data. By June 2025, China's actual utilized foreign direct investment reached $708.73 billion since 2021, hitting the 14th five-year plan target of $700 billion 6 months ahead of schedule. In the same period, 229,000 new foreign invested enterprises were launched in China, 25,000 more than in the 2016 to 2020 period. Despite all the talk about decoupling, despite geopolitical tensions, despite trade wars, foreign capital continues flowing into China at a massive scale. Now, some will point to the fact that headline FDI numbers have declined. Balance of payment statistics show net FDI inflows plummeted from a peak of $344 billion in 2021 to just $18.6 billion in 2024. But here's what the mainstream narrative misses. The decline in net flows is largely due to profit repatriation and corporate restructuring, not actual disinvestment. Utilized FDI reported by China's Ministry of Commerce stood at $116.2 billion in 2024, significantly exceeding the net FDI figure. The difference? Utilized FDI measures actual capital coming into productive investments. Net FDI subtracts money leaving. When multinational corporations repatriate profits after earning them in China, that counts as an outflow, but the productive capacity remains. The factories remain. The operations remain. More importantly, look at where the new investment is going. In 2024, high-tech industries attracted 34.6% of foreign investment, up 6 percentage points from 2020. The first half of 2025 accelerated this shift, with high-tech sectors attracting 127.87 billion yuan in foreign capital, with e-commerce services surging 127.1%, chemical pharmaceuticals up 53%, and aerospace equipment manufacturing rising 36.2%. This isn't capital fleeing China. This is capital repositioning within China toward the most advanced, most strategic sectors, the sectors that will define the next generation of global economic power. And despite overall declines, certain countries are actually increasing investment. European investments, particularly from the Netherlands, jumped 306.5% in 2022 and 19.2% in 2023. Utilized FDI from the United States increased 51.7% in 2023. Read that again. American investment in China increased over 50% in 2023, during the Biden administration, during maximum rhetorical opposition to China. The pattern doesn't care about political theater. It only cares about capital seeking the next power center. Foreign direct investment inflows in China saw a notable rebound in November 2025, surging 26.1% year-on-year. In the first 11 months of 2025, actual utilized foreign capital totaled 693.18 billion yuan, approximately $98.45 billion. In the first 11 months of 2025, a total of 61,207 new foreign invested enterprises were established in China, a year-on-year increase of 16.9%. More companies entering China, not fewer. The number of foreign businesses establishing operations in China is accelerating even as total capital flows moderate. Why? Because sophisticated investors understand the pattern. They're positioning for stage 4 completion. The institutions know what's coming. Let's be clear about what's happening. BlackRock isn't investing in Chinese military contractors because they love authoritarianism. JP Morgan isn't expanding Chinese operations because they hate America. Goldman Sachs isn't increasing its Chinese presence out of ideology. They're doing it because they understand the 4-stage pattern. They understand that reserve currencies don't last forever. They understand that when fiscal dominance sets in, when debt exceeds 120% of GDP, when interest payments grow faster than the economy, the transition to a new power center becomes inevitable, and they're positioning their capital accordingly. U.S. materials science giant Corning plans to localize production of high-end optical fibers in Shanghai, responding to the need for denser, faster data transmission in AI data centers. Mercedes-Benz China poured over 10.5 billion yuan into Chinese research and development over 5 years, with its Shanghai R&D center now leading global development for the company. These aren't short-term tactical moves. These are strategic investments in China's technological infrastructure. The kind of investments you make when you believe China will be the center of global innovation and economic power for the next generation. And it's not just Western companies. According to the United Nations, global FDI fell 11% in 2024, marking the second straight year of decline after a sharp drop in 2023. Global investment is contracting everywhere, except in China's strategic sectors. That tells you everything. When global capital is scarce, sophisticated investors allocate it to where they expect the highest long-term returns. And increasingly, that means China's high-tech industries, the same pattern that saw British capital flow to American railroads in the late 1800s, the same pattern that saw American capital flow into Germany during the 1920s Reconstruction, the same pattern that sees capital flow from declining empires to rising ones, why the trade war was always theater. Now you understand why the trade war was designed to fail. You cannot fight China with tariffs, while MSCI systematically increases China's weight in global investment indices from near zero to over 40%. You cannot reshore manufacturing while your largest financial institutions channel American retirement savings into Chinese companies. You cannot maintain dollar hegemony while running trillion-dollar deficits that require continuous monetary expansion. The contradictions aren't accidental, they're the mechanism. The population sees the tariffs, the headlines, the tough talk, political theater designed to create the appearance of resistance. Meanwhile, the actual financial integration accelerates behind the scenes through index inclusion, institutional investment, and corporate expansion. This is exactly how it worked during previous transitions. The British population didn't understand in the 1880s that their capital was building American industry. They saw their empire, their navy, their pound sterling dominating global trade. They didn't see the systematic capital flows that would eventually transfer economic power across the Atlantic. The German population didn't understand in the late 1920s that American banks were facilitating their hyperinflation cycle while simultaneously positioning for the next phase. They saw the economic chaos, the political upheaval, the currency collapse. They didn't see Wall Street's strategic repositioning. The American population doesn't understand now that Wall Street is building China's financial infrastructure while Washington performs resistance. They see the trade war, the sanctions, the decoupling rhetoric. They don't see the $6.5 billion flowing into blacklisted companies. They don't see MSCI index changes. They don't see the 229,000 new foreign enterprises establishing operations in China since 2021. The mathematical certainty. Here's what makes this pattern so devastating. It's not political, it's mathematical. When a monetary system is based on debt creation, when the entity that creates money is separate from but dependent on the entity that taxes, when the system expands beyond productive capacity, the currency inevitably debases. And when the currency that debases is the global reserve currency, the architects of that system move their capital before the collapse completes. This isn't prediction. This is historical pattern recognition applied to current data. The U.S. debt to GDP ratio stands at 121% as of December 2025. Britain's pound began losing reserve status when debt crossed 100%. Under CBO projections, U.S. debt will reach 156% of GDP by 2055, but those projections assume no crises. The last three major crises, the 2008 financial collapse, the 2020 pandemic, and the current inflation cycle, each added 10 to 20 percentage points to the debt ratio in a single year. The next crisis, whatever triggers it, will push debt past 150% almost immediately. At that level, the mathematics change. Fiscal dominance becomes total. The currency begins losing purchasing power rapidly, and reserve status shifts. Janet Yellen stated the preconditions for fiscal dominance are clearly strengthening. That's the former Federal Reserve Chair, the person who ran U.S. monetary policy, telling you directly that the system is entering late-stage failure. Eric Leeper noted that for most of American history, the U.S. operated under the Hamilton norm, the expectation that any debt issued today would be fully financed by future tax surpluses, but that norm died in 2020. Translation: nobody believes America will ever run surpluses again. Nobody believes the debt will be repaid. Once that psychological shift solidifies, once markets collectively understand that the debt is permanent and expanding, confidence breaks. And when confidence in the reserve currency breaks, capital flees to the next power center. That's where we are. Stage 3 approaching completion, Stage 4 already executing. The debt unsustainable, the monetary policy trapped, the interest payments accelerating, the financial institutions repositioning, and the population completely unaware that the greatest wealth transfer in modern history is happening while they watch political theater. What this means for you. So what do you do with this information? First, understand that the timeline isn't tomorrow. This pattern takes 5 to 20 years to complete once fiscal dominance sets in. We're probably in year 3 or 4 of that window. You have time, but not unlimited time. Second, understand that holding assets denominated purely in a debasing currency is a choice to participate in the wealth transfer mechanism. Your dollars, your bonds, your cash savings, all losing purchasing power as the currency supply expands faster than productive capacity. The inflation isn't temporary, it isn't transitory, it's the mathematical outcome of monetary expansion disconnected from economic growth. Third, understand that the institutions executing this pattern are not your friends. They will not warn you when the transition accelerates. They will not tell you when to reposition. They're already positioned. BlackRock has billions in Chinese assets. JP Morgan has majority-owned operations in Chinese financial markets. Goldman Sachs has increased its Chinese presence throughout the trade war period. They moved while the narrative was decoupling, while the public was distracted by political theater. That's how Stage 4 always works. The architects move first. The population realizes last. Fourth, understand that geographic diversification becomes critical, not because you're unpatriotic, because when empires enter late-stage decline, capital controls often follow. Wealth taxation, exit taxes, restrictions on international transfers, making it illegal or prohibitively expensive to move wealth across borders. Look at Argentina, look at Venezuela. Look at any country that entered hyperinflation. Capital controls come early in the crisis, not late. By the time it's obvious to everyone, the exits are already closed. Fifth, understand that the next 5 to 10 years will not look like the last 30. The dollar's exclusive dominance is ending. That doesn't mean the dollar disappears overnight. It means the dollar loses purchasing power relative to hard assets, gold, productive real estate, strategic commodities, equity in companies with genuine productive capacity. These maintain value through monetary transitions. Paper currency does not. The pattern is absolute. The same mechanism that moved British capital to America in the 1800s. The same mechanism that moved American capital into Weimar Germany and then back out before the collapse. The same mechanism that positioned capital away from dollar-gold convertibility before Nixon closed the gold window in 1971. That same mechanism is moving capital into China right now. 61,207 new foreign invested enterprises established in China in the first 11 months of 2025 alone. $708.73 billion in foreign direct investment since 2021. High-tech sectors attracting 127.87 billion yuan in the first half of 2025. While politicians argue about tariffs, while think tanks debate decoupling strategies, while the media obsesses over trade war optics. The actual wealth transfer is 3/4 complete. The pattern doesn't care about your political preferences. It doesn't care whether you believe in American exceptionalism or Chinese authoritarianism. It doesn't care about technology or artificial intelligence or modern monetary theory or any other intellectual framework designed to explain why this time is different. This time is not different. The mechanism is mathematical, and it is executing right now while everyone watches the political theater and misses the systematic capital repositioning occurring behind it. You now understand the 4-stage pattern. You've seen it play out in Britain, Germany, and post-Bretton Woods America. You've seen the current data proving we're in late stage 3 with stage 4 already underway. The only question left is what you do with this knowledge. Do you position accordingly, or do you wait until it's obvious to everyone and the opportunity to preserve wealth has already passed? Make sure you're subscribed. Hit the notification bell. Share this with someone who needs to understand the pattern. Because in the next video, I'll show you the specific asset classes that have preserved wealth through every historical reserve currency transition, the exact strategies the financial elite use during stage 4, and the warning signs that tell you when the transition is about to accelerate. The wealth transfer is happening. The only question is which side of it you'll be on. The pattern is absolute. The mathematics is certain, and time is running out to position before the final stage completes.